Get Rich Education is brought to you by Producers Wealth and Ridge Lending Group.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to GRE. This is Get Rich Education, episode 180. I'm your host, Keith Weinhold. Today, we're talking about real estate appreciation versus real estate cash flow. We're also going to discuss appraisals. What happens when you get a low appraisal on a turnkey property and why exactly that can happen sometimes. In comparing appreciation and cash flow, I'd like to back you up to the beginning here, okay? Real estate investing begins with you. You are the most important thing. Don't fall in love with property. In fact, stop looking at property completely for a minute if you have to. Yes, as an interested real estate investor, you do need to stop looking at properties first. Because in real estate investing, the property is only the fourth most important thing. I know that's counterintuitive, but first ask yourself this question. What do I want most? Do I want real estate to produce income for me? Do I not really need cash flow, so I want appreciation the most? Am I in it for the tax advantages? Am I in it for lifestyle investing? Or am I in this for some other reason? So answer that question for yourself and your family first, because you are the most important thing in real estate investing. Secondly, the market is important, whether that's a geographic market or whether we're talking about a use type. The best market that fits the criterion that you want probably is not in the town where you live. The third most important thing is the quality of your team, like your property manager and maybe a good income property agent, because a bad manager, they will drive a great property into the ground. You see, if real estate doesn't work for you and it isn't in a good market and it doesn't have a good communicative manager, well, if any of those three don't work, then the property just doesn't matter. It will not perform for you. Real estate is the greatest wealth creator ever, but do you know why you hear bad stories about how someone was dissatisfied with their real estate investment and now they're just all turned off by ever wanting to invest in real estate again? One huge reason people have a bad experience is because they started with the property. People make the mistake of starting out by looking at properties, and that's why you hear bad stories of how they had an awful rental or landlording experience. So get yourself, get your market, and get your manager figured out first, and then you can start looking at property. When you're thought out and you're strategic in this way, now you have greatly enhanced your chances of getting what you want because you first started with yourself. And I do want to give credit. I think I first heard some variation of the property only being the fourth most important thing from the real estate guys, Robert Helms and Russell Gray, years ago. Now, if either cash flow or appreciation are what's most important to you, then you are really going to like this episode. And what is the importance of cash flow, that monthly income stream? Well, unlike a lot of investments, you know what? Even if your asset value goes down, cash flow means that you've already got some money out. You might have been getting money out of that for years before the property even went down in value. And you might still continue to get money, cash flow out of it, even with a depressed value. Cash flow is also more reliable than appreciation. It's more predictable. Appreciation is more speculative, and maybe you allocate a portion of your portfolio toward more speculative appreciation and a portion of it toward cash flow. Buying for cash flow is important because now you control the mortgage and all the operating expenses. And that's great, but realize after all that, it's appreciation that's often a greater wealth generator than cash flow. Just look at when I discuss the 5 facets, the 5 ways that real estate investors are paid. Just look at the numbers in that example. 6% appreciation when you're leveraged 5-to-1, that's a 30% return to you. Well, it's extremely unlikely that your cash flow is going to create a cash-on-cash return of 30% to match that. Some people these days seem happy with 6%, 5% on a cash-on-cash return basis. Well, what happens when the cash flow dries up in a market like the Dallas-Fort Worth metro that's seeing rapid increases in population, massive job growth, and a lot of real estate appreciation? Well, that's what my guest and I are discussing today. I'd like to welcome back onto Get Rich Education today, American Real Estate Investments Managing Partner, John Larson.
Hey, Keith, how you doing? Thanks for having me on again. It's a pleasure.
Well, how I'm doing is I'm dry and comfortable. The last time I was with you, you and I were cave tubing about 300 feet below the Belizean jungle.
That is true. That was an excellent time. That was something that I remember I wasn't really prepared for that. Didn't have the shoes for it, didn't have anything, but we made the most of it, and it was a great experience.
It was a great experience, even when bats flew from the cave ceiling down toward your face. So glad you made it through that one.
Yeah, that was terrifying. But yeah, we made it out alive.
Now, interestingly, you operate in 4 different turnkey markets. Your company operates in Dallas, Texas, Houston, Texas, St. Louis, Missouri, and Kansas City, Missouri. And, you know, that really gives you an interesting perspective when you're looking at balancing out cash flow markets with appreciating markets. Now, cash flow and appreciation, those are 2 of the 5 ways a real estate investor is paid. But the reason we're keying in on those 2 is because the other 3 ways that you're paid with real estate investing, principal pay down, tax advantages, and inflation hedging, those things are not functions of the market. So just talk to us about the perspective of cash flow and appreciation as you see it as the professional operating in these markets.
Yeah, great question. So, you know, with the cash flow market, the reason why we like Missouri so much is the property taxes in that market are lower than many other markets and states and major cities across America. Also, the median home value in those markets is a little bit more affordable. So when you put those 2 things together, obviously property taxes are an expense that you pay into each year. The lower they are, the more cash flow you're going to receive from your rental income. And then when you mix that in with a lower price, well, I'd say lower median value, then you can buy properties in still safe neighborhoods for a more affordable price. That's where you get your higher rate of return on a cash flow play from rental income. Now, on the flip side, many of these same markets like Kansas City and St. Louis, some other Midwest markets in America, you don't really see the appreciation play. These properties, they may appreciate in a healthy market like we're in today, but when you run into situations where we go through tough economic times, history has shown us that the Midwest is kind of affected most when we go through a recession. I think that's due to the fact that, you know, it's the Rust Belt. There's still a lot of jobs there that are manufacturing jobs, blue collar jobs, things of that nature. So when we go through a recession, we're not building things as much. It seems like those markets are the ones that are affected first.
Right. Some sections of the heartland might be less resilient during a recession, during a downturn. Now, interesting when we talk about appreciation versus cash flow, we need to realize that some investors don't need cash flow, even though I emphasize it a fair bit on this show. So just tell us about what do you look for in an appreciation market? Again, yourself as the professional. And, you know, John, it's really interesting that I'm talking to you because although your company's based in Dallas and you're there now, you're not a Dallas native. You specifically moved there to Dallas, an appreciating market.
Exactly. I actually originally came from a cash flow market. I'm from the Detroit area. So I moved to Dallas specifically because I saw, you know, the boom that everybody else is seeing, right? There's tons of jobs moving into Dallas. Dallas is home to 43 Fortune 1000 headquarters. It's actually home to the most corporate headquarters in America. So there's tons of jobs here in Dallas. And when you look at how many people are moving into the market, so 400 people a day are moving into the Dallas-Fort Worth Metroplex.
That's astounding.
Yes, exactly. And you see how many jobs are going into this market. And the fact that the property value is still affordable in my eyes. You know, you look at the nation's median home price, you're looking at about $280,000 right now in today's market. That's about right in line with the Dallas market. So I wouldn't say that the Dallas market is inflated, right? It's still affordable for the amount of people and the amount of demand that there is for property. I don't know how much longer that's going to last. But that shows me as an investor that there's a really good opportunity to really capture that appreciation growth and ride that wave to where you can really eventually down the road cash in on some serious equity. And that's through refinancing your property or potentially selling your property one day. And if you're buying properties in areas in any market, specifically, let's just talk about Dallas. If you're buying a property at median value today, that means that's where all the middle class is looking to buy homes. And the majority of those middle class are actual owner occupants. They're retail buyers. So I would imagine 2 to 3 years from now, let's even say 5 years, if you plan on selling that property, your exit strategy should be pretty easy. And you should also be able to capture full equity on your property, right? Because these buyers are willing to pay market value or more to purchase that home from you. You're not buying this property in a more distressed neighborhood where really it's only attractive to renters and investors. And those properties are strictly traded on cap rate.
Right. And we've walked those attractive A-class neighborhoods in suburban Dallas. And I think anyone that's bought in the Dallas-Fort Worth metro in the last 8 years, they're feeling pretty good. You mentioned a price point of $280K. And there is a difference between inflated and overinflated. So really, when someone comes to you and asks you, John, when they say, now, come on, when does a market become too hot like a Denver has or a Phoenix has, where the numbers really don't make sense by and large in those metros any longer? Or the extreme example, Southern California and New York City. I mean, those areas are long gone. In Atlanta, significant sections of that metro are gone as far as what's going to produce cash flow. So talk to us about when Dallas is going to be on that list. When does it become too hot?
Yeah, great question. It's pretty simple, in my opinion. I believe that a market becomes too hot when you cannot buy at or near median value anymore with a Fannie Mae loan. So 80% of value, right? You're only putting 20% down, low interest. We're looking at rates lately hovering around 5, maybe a little slightly above 5. If you can't buy in a true middle class neighborhood or buy at that median value in that market or around it, right near it, and still see positive cash flow, then I believe that market's hit its peak. It's just too hot at that point, because I'm not going to sacrifice safety in my investment. I'm not going to go buy something more risky just to get, better cash flow numbers on a spreadsheet.
Now, safety is a really interesting word. It's really not a word that we throw around here at Get Rich Education too often, but it still matters even if you're not keying in on it. So when it comes to a safe asset, how do you think of and how do you define a safe asset in real estate investing?
Well, I believe that anytime, going back to median value, if you're buying close at or close to median value in any market, you really should be positioning yourself in a safe single-family home. That's where the true middle class is looking to purchase homes for themselves. That's where the true middle class is looking to rent properties. These people have good jobs or probably on a salary-based job. So when I look at safety, I look at the quality of tenant that I'm going to attract in the property. Do they have a good, stable income, right? So I want to have low risk for evictions and things like that. So I know that my tenant can afford their bills. Even if something in life happens, like a car breaks down, a divorce happens, whatever it may be, they still have good, consistent income coming in to pay their bills and pay me rent, right? The other thing that I'm looking for is, if you are able to buy at that median value in any market, you're usually in some safe neighborhoods. You should probably be in neighborhoods where you're avoiding a lot of high crime and avoiding theft and break-ins. So what if your property goes vacant? If it's not in the best neighborhood, you're going to have issues with break-ins. You're going to have issues with vandalism. You're going to have issues with people breaking into your house and squatting. I've gone through that same stuff back in Detroit when I was investing in C-class assets. You got to start somewhere, so I didn't have as much capital available to me at that time. So I started, investing in properties that were well below the median value in the Metro Detroit area. And I just found that I ran into a little bit more trouble. So if you're buying at that median value, I think that you're really safe.
Yeah, it's interesting. How do you be safe? Well, you go ahead and you buy in a safe neighborhood. How do you attract a quality tenant? You buy a quality asset in a quality property. Mm-hmm. Sometimes it's really just as simple as that. And the word safe is really interesting. And even though I probably don't lead with the word safety in my buying criteria, I can't think of any metro safer in the entire United States than Dallas-Fort Worth for what is most likely to not have a recession and a depression in prices anytime soon. Even back in 2007 to 2009, we didn't see much of a loss of prices, and that was a historically bad housing recession. So I really think about safety in DFW.
Yeah, absolutely. I mean, you definitely saw a slowdown in development in Dallas-Fort Worth at that time. But really, if you look back and look at the historical data, there was no change in value. Values held strong. Now, did builders stop building new homes? Yes. But the values were there because the jobs were there and the people were continuing to move here.
Now, with appreciation, it's sort of interesting. There's really a mindset around investing for appreciation versus cash flow. And you know how I've heard some people compartmentalize it, John? You know, they've said that I want to invest in a place like Dallas-Fort Worth because even if I don't get monthly cash flow, I have such a reasonable expectation that I'm going to get appreciation in the next few years that if I cash out in 5 years, whether that's a sale or cash out refinance, I feel like I'm going to be getting a measure of lump sum cash flow in 3 to 5 years.
Exactly. And many sophisticated investors that I work with and I'm friends with and I know in the Dallas market, you know, I have an anesthesiologist in my building, in my office, right, or, down the hall from my office. And he started purchasing properties in Grapevine, Texas. And if our listeners know where Grapevine is, it's close to DFW Airport.
Yeah.
And it's close to South Lake, which is the wealthiest area in the Dallas-Fort Worth area. So he started buying properties in Grapevine as we were coming out of the recession. He kind of like caught that appreciation wave. None of his properties cash flow, but he owns 7 or 8 homes, he told me, and he's sitting on well over $1 million in equity. So when he does plan on selling those here soon, he's sitting on a nice chunk of change. So I definitely have to give that guy a pat on the back. He knew what he was doing for sure.
Now, that lump sum cash flow phase, okay, that's certainly more speculative than going ahead and investing for month-to-month cash flow. I've pointed out before, John, on the show, that even at historic appreciation rates of 6%, that when you're leveraged 5 to 1 and you buy 5 $100,000 properties with 20% down, just as an example, not that they're that inexpensive in Dallas right now, but your $100K of equity goes to $300K in 5 years. And again, that's just at historic appreciation rates of about 6%. So that's just a very concrete example of where lump sum cash flow comes from. Just realize how that fits into your risk tolerance.
Yeah, exactly. And that's why I'm still in, Kansas City and St. Louis for cash flowing investments, because I'm a firm believer in diversification. Obviously, these cash flow properties that are a little bit lower barrier to entry that provide higher rates of return on the cash flow from rental income, but don't necessarily give you that appreciation side. Well, those are a great way to supplement income, I believe. Now, with the A-class investment, it's just a different investment strategy. It's a different investment game plan. I tell my investors all the time, I don't talk bad about any investment. If it makes money, it makes sense. Now, with the A-class inventory that we have here in Dallas, the reason why I have a waiting list of people that want my homes is because they're taking advantage of the Fannie Mae leverage. They're only putting 20% down on a $250,000 home in a great suburb of Dallas that's going to attract a great tenant. Okay, that tenant's not going to be any risk for eviction or anything like that. They're going to pay the bills, pay down your principal balance, and by all accounts, I can't really see this market slowing down anytime soon, the way that the economy is and the way that people keep moving in. So for that $250,000 asset, you're giving me $50,000. Let's call it $57,500 with closing costs. We're making up that $57,500 in appreciation in 2 to 3 years in this market. So in 2 to 3 years, you could potentially do a cash out refi, pull that money out. That's 100% return on your money. That's something that these, let's call it cash flow market properties, can't provide you.
Yeah, and you know what's interesting, John, is in a more holistic sense, some real estate investors look at investing in Dallas-Fort Worth as a portion of a blended portfolio. And what I mean by a blended portfolio here, while we're talking about cash flow versus appreciation, is they might be invested in Missouri markets, Memphis, and Dallas, because in Missouri markets and Memphis, that's where they're getting cash flow. And in Dallas, that's where they feel like they're getting appreciation. So when you blend everything together in the 5 ways that you're paid with real estate investing, that's what makes for a holistic blended portfolio.
Absolutely. And if you're working with a company, and it's not just mine or any other company out there, and if you're looking for leveraging a team, a turnkey team, because I will tell you, buying and renovating homes, it's a lot of work. It really is. I don't think that people really understand how much work actually goes into it unless you actually do it. So if you're working with a company like us, or there's other companies out there that are in multiple markets, the benefit of working with a company like mine is you could purchase properties in Kansas City and in Dallas, and you only have one main point of contact. So that's actually pretty comforting in my eyes.
We're talking with American Real Estate Investments Managing Director John Larson. We're talking about cash flow versus appreciation, median monthly rents versus median values. We're going to come back and talk about that, and also what happens when you get a low appraisal. You're listening to Get Rich Education. I'm your host, Keith Weinhold. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We're talking with American Real Estate Investments Managing Director John Larson about cash flow versus appreciation. John, as a market heats up, the median value of a property typically exceeds and outpaces the median monthly rent. The rent does not keep up commensurately with the median value. So tell us more about what you look for in that circumstance.
Yeah, that's another great question, Keith. What it is, I mean, if you look in any market, so even in Missouri, for example, I believe, the median home value out there is probably closer to maybe $200,000. The median rents in that market are not $2,000.
Right.
Same thing goes here in Dallas. So I mentioned earlier that the median home value in the DFW area is $280,000. The median rents are not $2,800. Now, although in appreciating markets like a Dallas or, Phoenix, although the values of homes are rising, rents do rise, but in middle-class neighborhoods, they eventually plateau, right? I try and caution investors to look at everybody who kind of wants to pigeonhole and say, okay, well, I need to have 1%. Well, that's not necessarily accurate because depending on what the median home value is in a market, if you're looking for 1% rent to price point, you could be setting yourself up to buy in a bad neighborhood because then you're going too far below that median value. So I think that what you need to do is you need to try and make sure that you're close, especially in these appreciating markets. But in the Midwest markets that we're in Kansas City, Missouri, so let's say that the median value is $200K. If I'm positioning you in a neighborhood where homes are $150,000, I wouldn't call those bad neighborhoods. I would definitely say those are good entry-level middle-class neighborhoods where then you can now get closer to that 1%. I would say a $150,000 home in Kansas City or St. Louis will rent for as high as $1,350. Well, that's close, but you're not going to get $1,500. So I just always hear from my investors, they come over and they say, well, I'm really looking for the 1% rule. Well, in today's market, we're in a very hot market. We're in a seller's market. Prices keep going up steadily. I just think that investors definitely need to reset expectations that if I'm going to buy at 1% rent to price point, they just need to caution themselves that they could be setting themselves up to buy an investment in a neighborhood that's just not that safe, not that desirable, and might be open to more things like crime and theft and the other things that we mentioned earlier.
Now, we've mentioned how in a market that's heating up, rents don't keep up proportionally with median value, but how are rent increases looking across the markets that you're in, Dallas, Houston, St. Louis, and KC?
Well, I've definitely been able to increase my rents in Dallas since 2012 when American Real Estate first started investing down here. But I am seeing certain situations. We'll see, Toyota's still kind of moving into this market and things like that. So I do fully expect demand to even increase more in the North Dallas area, which could potentially push rents up because you're talking about a bunch of people from California moving over to the Dallas-Fort Worth area. They could look at a $2,500 rent and laugh like, are you kidding me? I'm used to paying $4,500 where I'm from. So, I think there is an opportunity to still see rents increase in this market as demand continues to grow. But I've definitely seen in some of the neighborhoods that we're buying in that are the true middle class neighborhoods, we're starting to see rents kind of plateau around $2,200, $2,300, because you just start to get to a point where these are still middle class suburbs. And we're looking for tenants that qualify for our homes that make at least 3 times the monthly rent gross. So if you start pushing it too much, you just start pricing yourself out from like that tenant pool.
Right.
Although the appreciation in this Dallas market is definitely outpacing the rental increases, we have seen increases from year to year. And I would say it's been anywhere from $50 to $100 increases each year since I've been down here since 2012. And up in the Missouri market, it's been a little bit more steady. You're not really seeing as much rent appreciation in those markets. But it's also an area that just doesn't have the diverse economy that we have down here in Dallas. It doesn't have the population growth that we have in Dallas. So it's a little tougher to push rents in those markets.
Now, as prices of assets increase, one problem potentially can be that appraisals don't necessarily come in and keep up with that, because here in the 1 to 4 unit space, appraisals are typically based on comparables and sales that might have happened in the last 6 to 12 months. So let's just talk some more about why an appraisal might come in low. I think one reason that's certainly possible is that a home could be overpriced somewhere, but just tell us about other reasons why appraisals can come in low, specifically on turnkey properties.
Turnkey can kind of get a bad name sometimes when it comes to appraisals, and more so the reason being that appraisers, in my experience, and I started off in this business as a regular just retail real estate agent, and I dealt with appraisers a lot. What I've noticed with appraisers is obviously they're looking at what's sold recently in the neighborhood. They're looking at true comparables, so the same 3-bedroom, 2-bathroom home, about same square feet. But appraisers, what I've noticed, also get really caught up in the glitz and glamour of the property. They walk into the home and they're really looking at what type of appliances are in it, what type of flooring is in there. Is there granite countertops? Is there not granite countertops? Things of that nature. So I've just seen in my experience that many appraisers are really looking for kind of like what the cosmetic finishes look like, and not necessarily what the bones and major appliances of a home, have those been replaced. So many turnkey providers and myself, we are going in and replacing roofs, we're replacing HVACs, we're replacing windows, things of that nature. But we're not necessarily going to put granite in all of our homes. We're not going to do nice, beautiful tiled backsplashes in all the kitchens and beautiful tiled bathrooms. We're looking at doing a more durable renovation when it comes to the finish out of like the flooring and things like that. So maybe we use a vinyl plank instead of, engineered hardwood or true hardwood in a property. We're just doing that strategically to keep costs down for our investors. But we're paying attention to the big fix items so we keep capital expenditures low for our investors early in ownership. So I just don't think that many appraisers take that stuff into account. And that's why sometimes we can run into some appraisal issues here and there. Now, also, turnkey providers obviously make money by buying and renovating and then reselling these homes to investors. So they have a margin in there. And that's where sometimes an appraisal can come in slightly low because that turnkey provider's fee is built into that price. And just to remind investors out there that are listening to this, if you've ever flipped a house by yourself, I'm sure that you know how difficult it is. And especially in today's market, it's very difficult to get good deals. So one, there's a lot of value in these turnkey providers just getting these properties in good neighborhoods and getting good deals. But then the professional renovation that they're doing, and I'm not saying all turnkey providers do very good professional renovations. Our company does, and many other people that are competitors, I could say, do. So you're getting a lot of value there. But yeah, that could be a couple instances of why an appraisal may come in low.
Now, when you think about turnkey and the nature of it and how that property is almost completely rehabilitated, just like you described there, interestingly, that property, if you want to say that that property is in an infill area, that might be flanked by properties that were built in the 1980s or older. And a lot of those that are flanking the subject turnkey property there, they're going to have deferred maintenance pretty soon, but your brand new turnkey isn't necessarily. So to appraise something the same as one right next to it, which is often the case in turnkey, where you're looking at a property that's different than the character of the ones around it, can that affect appraisals?
It most certainly can. That's another thing that could definitely have an effect on you. So, we just try and let our investors know, remind to our investors that this property has gone through a very durable renovation. And in my opinion, if I'm going to buy any single family home and use it as a rental and a cash flow producer, I'm more concerned with, making sure that the finish outs are durable and are cost effective to replace. And really the main thing I'm going to care about is that, the roof has a substantial amount of life left on it. Same goes for the HVAC, windows, the high cost expenses.
Yeah, and there are a lot of cases where appraisers won't look at off-market comps or settlement statements, HUD statements, and they'll only refer to the MLS for market data. Well, then by doing that, those appraisers aren't taking all the data available. And in a hot market like Dallas, the majority of the sales are done off-market.
Absolutely. That's another great point that you brought up, Keith. We run into that situation in Dallas from time to time, which is why we work with a tight-knit group of lenders. But yeah, if these appraisers are not willing to look at off-market data in Dallas and Texas, the state of Texas, it's a non-disclosure state. If you sell a property off-market, which we sell all of our homes off-market, you do not need to record what the sales price was. And so in a hot market like this, where there's very low inventory, you see a lot of for sale by owners. There's not really any reason to hire brokers in this market. You can definitely sell a home very easily in this market just by sticking a for sale by owner sign out there and posting your property on Zillow and Realtor.com and things like that. You will get attention to your property. So we see a lot of that in Dallas. And like you said, if that appraiser is not willing to look at off-market settlement statements and take those into account as well, then they're not taking into account all the data that's out there.
So let's say an appraisal comes in low, whether it should have or should not have. Anything you advise prospective buyers about how they can go ahead and deal with that appraisal that just came in lower than the contract sale price?
Well, what we do in that instance is we go back to the lender, and a lot of times we'll ask for a second opinion. So we'll have that lender send another appraiser out, and we'll take the better of the two values. Because I tell my investors all the time, look, if we sent 3 different appraisers to the same property, we're going to get 3 different values back. Appraisals are an opinion of value. And, you know, if I have one appraiser that's going to look at 5 settlement statements that I have on properties that I sold in the same area in the past 6 months, and one appraiser doesn't, well, I guarantee that the appraiser that took my off-market data into account, my value comes in higher.
Now, back in the day, you know, I was investing in real estate since 2002. I remember I had a substantial appraisal for a cash out refinance on a fourplex building that I had, and it was just kind of the buddy system. An appraiser could just be chosen by a mortgage lender's favorite, and we kind of got the number to come in where we wanted to, just about. So Tell us about how appraisers are appointed now.
Well, now it's an appraisal management company, so it's a random draw. You really don't know who you're going to get. The big banks like Wells Fargo, Chase, all those guys, they use a very large appraisal management company. You really can't really build a relationship with these appraisers at all. The government has done that because of the 2008 crash and things like that. So they've really started to tighten up on things like that. I just recommend that my investors use investor-friendly lenders. I know you've had Graham Parham on your show before, Highlands Mortgage. I believe his company to be a very, very investor-friendly bank. They're easy to work with. They have a group of appraisers. Still, it's a random draw, but they have a team of appraisers that have done many appraisals on my homes, very familiar with my product. He works with all the major turnkey providers in the country. So there's others, but I just reference him because, you know, he's right down the road from me and he does a lot of loans for us. And we've had a very good experience working with him, and so have my investors.
Well, John, it's been great having you here talking about cash flow markets versus appreciating markets and appraisals as well. If you want to learn more from John and the markets that he operates in, basically pick your geography, getricheducation.com/Dallas or /Kansas City or /St. Louis, and we will hook you up with that report so that you can connect with the provider there at John's company. John Larson, it's been great having you back on the show.
Keith, thank you so much. It's been a pleasure. I always appreciate you having me on.
Yeah, the window is closing on Dallas cash flow. In 5 years, I think Dallas will be too expensive, and you're not even going to hear me talk about it on the show at that time, probably even sooner than that. And of course, we're talking about cash flow with a 20 to 25% down payment here, of course, because most anything would cash flow with a high enough down payment. The Tribeca neighborhood of Lower Manhattan would probably take a 70 or 80% down payment to produce cash flow today. So personally, I like the blended portfolio approach that I mentioned in the episode there. Picking some cash flow markets and maybe having a speculative appreciation market or two in there like Dallas is a formula that's right for some people to get a roughly equal measure of the 5 facets of real estate investing profit. I began buying Dallas-Fort Worth turnkey single-family homes back in 2012, and that's where I've experienced my best appreciation. It's nice when there's one provider that works across a few markets, and then you can pick what's most important to you, appreciation or cash flow or both, and just have one point of contact with that one provider. And that's what you can do here. So to learn more, the provider and I prefer that you get a market report and their contact info by starting at getricheducation.com/Dallas or /Kansas City or /St. Louis. And then you can look at properties, which, again, is only the fourth most important thing. Next week, Rich Dad Tax Advisor Tom Wheelwright returns to the show. Until then, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Ranked by Forbes as one of the fastest growing cities, Orlando, Florida has a big and diverse economy, yet still features affordable rental properties that cash flow. Our boots on the ground turnkey provider, Greg Bond, wrote a special report to help you discover the amazing market of Orlando. Request your free copy today. Visit GetRichEducation.com/Orlando. That's GetRichEducation.com/Orlando.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.